New intro, y'all. New intro. Who dis? Hope everybody is doing well today. It is, what day is it? It's April the 29th, I believe, already. So this is our April Power Numbers Live. As a reminder, we're here every single month, typically on the last Wednesday of every month. And this is my chance to be able to come live and talk about things that are actively happening in the world that are relevant to small business owners. This is where I tend to get a little bit nerdy. So we're going to get nerdy today. Just as a warning, we're going to talk about economics. We're going to look at some indicators. It's going to be a lot of fun. It's a little insight to what I do in my spare time. And today we're going to talk about inflation specifically and what's going on with inflation. We're going to talk a little bit about tariffs. We are going to talk about to-dos, of course, because every Power in Numbers Live, we talk about news, to-dos, and cues. Those are our three different segments of this show. And then I'll take your questions at the end. So if you're here joining me, say hello. If you're watching this on replay, also say hello. And I'm going to start by introducing our fabulous sponsor, who is OnPay. OnPay is actually the payroll system that I moved to last year. So if you're curious about OnPay, if you want to know more about them, I have really had a great experience. And moving payroll was something I actually, even I, who am a numbers person, this stuff doesn't usually scare me. I put it off and put it off and put it off because I knew it was going to be a process. And so when I actually finally went through with switching to OnPay, it was actually so much easier than I thought it was going to be. It was so much smoother. I love the OnPay team and I love the platform as well. So if you know that you need to switch payroll, or maybe it's going to be your first time getting a payroll solution up and running, I definitely recommend OnPay. And of course, with my link, you get a special deal. So you can switch to OnPay and get $100. Yay. Who doesn't love free money? Using jamietroll.com/OnPay. All right. So let's jump into our first segment. And you're going to see, if you're here, you get to see some of our new graphics. We have some new things rolling out soon. So our look is changing a little bit over here on jamietroll.com and on the YouTube channel. You might have noticed this, but if you haven't yet, you will now. I love these new graphics. They're so fun. Okay, so this is the news section today, and we're going to talk a little bit, like I said, about the economy and what's really going on behind the scenes. If you were with me last month, which actually I think that one was on April 1st or 2nd, it was the beginning of this month, I talked a lot about stagflation and the dangers of stagflation and what can happen if you have a stagnating economy and rising inflation. And we're going to kind of build on that a little bit today. I think everything we talked about last time is still very relevant, but I want to build and talk even a little bit more about what inflation means, because I'm finding that we don't always have a good reference point for thinking about inflation in terms of how it impacts us. We see it at the grocery store, right? But over the long term, what does that look like and why does it matter? And also, what is, the current economic policy and monetary policy doing, and what can we expect from that? Every economic policy is all about trade-offs. And so anytime a choice is made, there are going to be trade-offs for that. So we're going to talk about that today. We're going to talk about whether are we living in an economy that might be a little bit propped up, and what exactly does that mean? So let's get into it now. Today, I'm going to share with you first, and you'll see all these links in the comments that I'm talking about so that you can take a look yourself. But let's go back to inflation, because I think that's kind of the starting point of this whole entire conversation. It's probably something you're aware of and thinking about from the standpoint of what's going on at the grocery store or at the gas pump. But let's look at it a little bit more holistically here. So this is, you guys who have been to Power Numbers Lives, I love trading economics. They have so many different charts. You can see all the different charts that they have for things. I love looking at this when I'm trying to figure out and piece together what's going on. This is where I get my numbers nerd hat on, and I go and I look at the data because I love data. And so that tells a story more than anything else really can. So what I see as the story in this data right now, March was we ticked back up in terms of inflation. Now, you also know, if you follow me, I'm really big on showing charts. This is only a chart through last year. You can see a little bit more the farther you go out, right? So if we want to really get the idea of what's happening, I'm actually going to take us out 10 years to show how this compares over time. Right. So last time we talked about how we typically kind of spent more time in the 1.5 to 2.5 range. That was kind of our typical inflation range pre-COVID. COVID, all of a sudden, we had some crazy stuff going on during COVID. We know this. We lived it, right? And so inflation went away. And that makes sense because ultimately people weren't spending, especially at the beginning of COVID when everybody kind of had to pull back before the economy then was flooded with additional cash in the form of stimulus, PPP loans, all kinds of various different things that were done by the government for good reason, right? They were trying to prevent a full economic, collapse, which would be a really big problem, not just for people, but also the government itself. Remember, the government relies on tax revenues. And so we do not want a giant economic collapse because then all of a sudden the money coming into the government also is declining. And then we have an even bigger problem. So that's why they made the choice to essentially flood, the economy with cash to keep it going. We then saw sort of what was a very predictable thing to happen. Again, I'm not saying it's good or bad, right? But the offshoot to any choice you make in staving off a full kind of economic collapse, we then saw a period of rising prices. Now, was this entirely due to COVID? No, not necessarily, but you can tell that obviously this was a time period where it peaked in, peaked at 9.1% in June of 2022. Now, this is not the first time the US has seen inflation rates like this. If you go back to the early 1980s, late 70s, early 80s, we saw even higher. I mean, it went into like 17% at times. It was pretty significant. So, but there is an effect to this, right? This impacts our purchasing power. Now, we seem to be kind of in a new normal, although it's a little tenuous. I don't know. It feels to me to be a little tenuous, right? It feels like, is the other shoe going to drop? I don't like this ticking up a little bit, but it's still kind of in that zone. But now our new normal looks to have increased. Instead of being kind of in that 1.5 to 2.5, we're now kind of in the 2.5 to 3.5 seems to be sort of our new normal. And that doesn't sound like that big of a change. Right? When you hear that, it's like, okay, well, it's not that bad. 2.5, what's the difference? 2%, 3%, 4%. Like it's not that different. I'm going to show you here in a minute how the compounding of numbers actually makes just even a 1% tick up in average inflation a pretty dang big deal. Okay. And how we need to think about this, as we move through now and into the future. So there's kind of the basis talking about inflation. Now I want to take you over to talking about government debt. And I don't talk a lot about this on this channel, but I do think it's important because it goes with this conversation. Let me pick the right screen. It goes with this conversation. That's consumer spending. Actually, let's go to consumer spending first. I'm going to take you to consumer spending first because that'll give you an idea of what's going on with the economy. So it may feel like things are getting tighter, but consumer spending is going up. Now, part of the reason consumer spending is going up and therefore the economy is going up is because of the price of things. We're still buying things and the price has gone up, even if we still buy the same amount of things, right, as before. All of a sudden, that's going to show as an increase in consumer spending. So I think we look at this sometimes as an economic indicator of, oh, look, people are spending. Everything's still good. But I think a large part of why we're seeing some of these upticks in consumer spending is less about us buying more and more about things being more expensive, right? So we can kind of see, though, if we see a contraction, that's where we start to worry, right? And we saw that contraction back in 2020. Here you can see exactly why. Like if you're wondering, why did we flood, flood the economy with a bunch of government money in 2020 and 2021. This right here shows you why, right? Because the knock-on effects of consumer spending going down could have been absolutely catastrophic, not just at the time, but into the future, right? And so in order to stave that off, and fix this situation where consumer spending was way down, therefore tax revenue is going to be way down, unemployment rate's going to tick up, you could go into full economic free fall. We didn't do that. Why? Because we flooded the economy with extra money, and it had the effect of inflation. So again, it's trade-offs. It's not about good or bad, right? There is no perfect solution that doesn't have some other effect. The economy is linked in that way. And when you kind of start to think of it and understand it, it makes sense, what's going on and why. And they're all choices that the people in power need to make about what's not necessarily the lesser of two evils, but maybe sort of, right? There's always anything that has a positive effect is also probably going to have some type of negative effect. And so that's something that we just need to be aware of and thinking about. Okay, so here you can see again, we're putting out, here's these, if you wanted to go play around with these charts, just go and click on any of these links that we have. Okay, now let's look at government debt. And I bet you can, I'll give you one guess. What's happened to government debt? Right? It's not that hard to figure out once you see what's going on. Well, this is how, right? Like in 2020, when we had to issue a whole bunch of extra, if we had to put a bunch of extra money in there, money doesn't grow on trees, right? We're generally going to be digging more into debt as a government as a result of it. So you can kind of see here what has happened to government debt over time. And let's look and see how long it'll let us go. So, it's increased quite a bit. However, right, so is inflation. So some of that is, just a general factor of inflation. Money is worth less now, like $1 is worth less now than it was in 2017. And so you're going to see this, but we are seeing debt increasing. And that's another one of those things that tends to happen. You can see a big increase here. Again, 2020, we just saw this. We saw this big increase. And we're seeing it too whenever there's things called, so they'll call them quantitative easing, which is essentially a fancy word for putting more money into the economy. Printing money is sometimes how it's colloquially called. We're not actually going in there and printing more money, but it sort of feels that way. We're issuing more government debt in order to put more money into the economy, right? And so that is one way. And when I talk about propping up the economy, this is kind of what I mean. What we've decided to do, instead of allowing natural corrections to the marketplace in terms of, okay, maybe we've gotten to the point where we might need to crash and reset, right? We might be creating a bubble in certain markets. Well, we don't want, these markets to crash. We don't want the housing market to crash. We don't want the employment market to crash. And therefore, what we do is we put more money into the system. And it does have the effect of either completely getting rid of or maybe just delaying a recession. People have wondered, why have we not seen a giant stock market crash? Why have we not seen a giant recession outside of kind of the little blip on the radar in terms of, what happened during COVID, which was a very specific, cause of that, right? But why haven't we seen a bigger recession, especially because we feel it, right? We don't feel like things are great. I haven't talked to very many people that feel like, oh no, things are great. Things are going really well. Money's just flowing in. I have more than I know what to do with. We don't feel that there is this surplus. We feel like we're on the brink. And I think this is why. I think that these charts show us why. We're kind of kicking the can, right? And we're feeling it in other ways. We may not be feeling a full-on total economic collapse, but we're feeling it at the grocery store because the trade-off to not having a giant recession, right, to not having these big market crashes is inflation. And that is a choice that's being made. Again, I'm not making a comment on whether that's good or bad, right? I think either way, you're going to have some negative, some negative offshoots, and this is what we've chosen. We've chosen inflation to be that potential negative offshoot. Now, there are other ways that we can combat inflation, right? And we can do that with interest rates and what goes on with interest rates. That's often why, to combat inflation, we'll see rising interest rates. And that's what the Fed did, right? Back after when interest rates went up, or when inflation went up, we saw the Fed increase interest rates, right? That has a knock-on effect of essentially, reducing the amount of spend of investing back into the marketplace of new building, new investment, things like that, because it's more expensive to borrow money, right? And so again, that affects the housing market as well. So there's just all these knock-on effects that we're dealing with, and it's left me feeling like what is being said about the economy doesn't feel like what most people are feeling like the economy is. And if that's you, right, I understand. It makes sense. And going back to that, I think there are multiple different economies. There are almost two completely separate economies that we're dealing with. Those who own assets right now, right, or those who own very cheap debt at cheap rates are doing great. Why? Because their assets are growing in value and their debt is fixed at a much lower rate, right? They entered into the debt when the dollar was worth less, and now they can pay it off with, inflated dollars. And so you really see the value of asset holders. I count myself as part of that. I've been very fortunate that we purchased a house. Actually, we purchased our very first house back in 2009, which was right in the middle of the market crash, which was actually a great time to buy a house if you could. And we thankfully were able to. We sold that house, made some money on that, invested into this house, which we bought in 2017. It has doubled in value since 2017. That is crazy. That is just bananas, right? I can't imagine being on the flip side of that if you're not a homeowner and you've been saving up all this money, right? Like maybe doing the Dave Ramsey way and trying to save up all this money to buy your home. And as you're saving up the money, the value, the cost of the home is growing faster than you can even save. That's what's happening right now. So there's these two various different economies. If you are not an asset holder, right? If you don't have stocks, which by the way, the top 10% of income earners in the US, we're not even income earners, the top 10% of net worth individuals in the US own 87 to 93% of stocks. Okay. So again, there's that economy. They're doing great. Dow at 50K, remember, right? Like they're feeling good. Their assets have appreciated. The stock market's doing great. Meanwhile, those who are not asset holders or not significant asset holders, right? Or maybe have debt at higher rates, like today's rates, those people are hurting because everything's more expensive. Inflation isn't good for that, right? So we're really stuck in this crazy loop, it feels like, where we have these two various different economies where on paper it looks like things are great, but they don't feel great. And I think that these charts show that story. Now, I want to take that another, if you will, like indulge me on a little bit more nerding out on this. If you like to play around with numbers the way that I do, I'm going to put up a calculator. And this is an inflation calculator. I had way, way, way too much fun with this. I'm going to be completely honest. I'm probably going to spend about another hour or two playing around with this after I'm done with this. But this is a great inflation calculator. And I'm going to show you this one right here. And here's where you can find it yourself. Now, what this does, it gives you a lot of really great information. Okay, if you can see this, let me try to blow this up just a tad so that you can see it a little better. How's that? Sorry about the ads. I can't get rid of them. I don't think. I don't want to click on it. It's going to bring something else up. Okay. But here you can put in any dollar amount, any year, and the end year and calculate out what that's worth. So what this is saying is $100 in 1950 is worth $1,370 today. Okay. Another way to think about that is that what you could buy for $100 back in 1950 now cost $1,370. Now, you understand if you were an asset owner and your assets appreciated, that's not so bad. But if you weren't, right, if you're a person purchasing something, then this is not good. So we're going to come down here. This is great. The average talks about the dollar had an average inflation of about 3.5% between 1950 and today. What's interesting, again, a lot of that is driven by a few really high years, right? In the late 70s, early 80s, and then in that 2020 timeframe. Other than that, if you take those out, it's more like that, 2%-ish inflation on a normal year. But that's a huge, huge price. That means that prices are 13.7% higher today than they were in 1950. And a dollar today only buys 7.298, about 7-ish% of what it could buy back then. Now, this is 1950. That's a long time ago. But you can see here's what I was talking about, where inflation went way up, right? We had some really high years. Actually, it looks like the highest year was 13.5% in 1980. And then we had ours here. But for those of you, and I love to point this out, because one thing I also want you to take away from this chart right here is if you're a business owner and you're saying, you know what, prices are up temporarily, they'll go back down. I'm not going to adjust my pricing just because my costs went up, because this is temporary, right? And I've been saying this, it's not temporary. Look how many times in the last 75 years we have had deflation, meaning prices have actually gone down from the year before. Let's see. We had 0.37% deflation in 1955, and we had 0.36% deflation in 2009. That was even with a market crash going on. We still didn't have deflation, right? So don't wait around. All that is to say, just don't wait around for pricing adjustments as prices are growing fast. Make sure you are adjusting and keeping pace, because otherwise you become the martyr. Big businesses, let me tell you, they are doing this. They have a process to increase their prices routinely based on the costs that are going into them. Small businesses do it, whenever, kind of, a little less often. There's not a process for most small business owners to do this. And therefore, we end up being the bag holders, right? We end up being the ones that are squeezed in this. And that is not a good thing. Okay. So there's just some really good, again, information here where we can look at, okay, $100, here's what it was talking about, right? Here's how it has adjusted for inflation, or said another way, $100 now can only buy, or $100 then, right, is worth about $7 now. So that's a big purchasing power shift. So if you want to take a look and play around with these calculators, I highly recommend it. You can put in whatever you want to see, and you can put in any date, like I said. But there's another calculator I also want to show you, and that's going forward. So this is the historical one. You can go and look back and see what's going on. But if you're curious to say, okay, what does this mean for my future? This is what I also want to talk about, because we can't change the past, but how could this impact us in the future? Let me pull up the right one. All right. So for those of you who are, I don't know, maybe you want to retire someday, right? What does that mean for you? Okay, here we go. Here's our inflation prediction. So in this case, we can put in, and we'll link to this as well, but you can put in the amount of money, the start year. The reason I'm using 2020 for this is because I want to show, because there was such high inflation in the early 2020s via the chart that I just showed you a little bit ago, right? I want to show you what could happen even if we're just at a rate of 2%, if we're looking at $20, because I feel like we could all anchor back to pre-COVID, what stuff costs, right? Like the old normal. So $100 pre-COVID, right? If we were looking at a rate of 2% and we're going through 2050, so it's about 30 years from 2020, about 25 years from now, right? What can we expect? Well, we can expect that $100 to now essentially be $205 in 2050. So that means in 2050, to buy what costs $100 now, we would need $205, a little more than double. That's a 2% rate, okay? So that doesn't seem like all that abnormal. In 30 years, could prices double? Yeah, okay. Like, we can deal with that. That's not so bad. But it's something we need to consider when we're doing things like saving for retirement and trying to calculate out how much money we need to save for retirement and what returns are going to be, right? Because, in general, we expect that if we're investing money, it's going to return higher than inflation. That's the key. If it doesn't, we got a problem. And that's where we have an issue. If you're holding cash, please don't hold cash, my friend, or at least not more than you can reasonably expect to need in the next like 6-ish months. It's better to put that money, even if it's a money market account. I put my idle money that I need access to, maybe like, that I want to stay liquid, in a money market account that at least is giving me a few percentage points so that at least I'm matching inflation, because I don't want to be losing money simply because I'm saving it. Okay. This is why that's so important, because if you put $100 under your mattress, it's only going to be able to buy, half of that, right? The buying power is going to be about $48 later on. So if you plan to be saving cash, this is going to be a problem for you. Make sure you are putting your money into an interest-bearing account. So here's what I was talking about with those, these inflation rates. It's showing you, and then it's showing you the actual through 2026, and then it's going to 2%. However, keep this in mind, right? About double. We're thinking about it's going to take about double the amount of money in 2050. What if this rate went to 3%? Remember, we're hovering in 2.5% to 3% right now. Okay. What does that do? Well, it makes a pretty big difference, right? So $100 now $260. So instead of what was it before, $48 purchasing power, $100 now is going to have the purchasing power of $38. So that's a big difference. 1% is all we changed between now and 2050. And that's a really big difference. You can see kind of that shift happening. Now, what if, God forbid, we end up in the territory where we're more like 4%? Again, a lot of people are like, what's the big deal? 2%, 4%, whatever. It is not good, but it doesn't seem that different when you're talking about 1%. But when we compound this annually, and this is what happens with numbers, we can make it work for us or work against us. In this case, right, inflation would work against us. All of a sudden now it's more than triple the amount of money. Okay. So you can see how this power of compounding, right? And we got this little blip here because of COVID and because of what happened there and the high inflation, right? If we average 4%, all of a sudden that $100 is only 30. So if you're trying to calculate, all right, what you need to have saved for retirement, and you calculate, you know what? I think I can get by in retirement with $1 million in, today's value, right? That's 100,000. If we average 4% inflation, okay, that's 3.2 million. That's 3.2 million, which means your $1 million is going to have the purchasing power of about $302,000. That's something you need to factor in when you are doing those calculations to determine how much you need to save in order to retire. And you're also going to need to think about that with regards to when you can retire, right? It's all going to factor in. So that 2%, 3%, or 4% inflation makes a really big difference. And I just wanted to illustrate that because it's been something that's been on my mind is, we hear numbers and they don't really resonate in terms of we're like, yeah, okay, we know it's high inflation. We're thinking about today in the store. But we need to think about the long-term effects if we continue the monetary policy that is basically saying, you know what, we're going to try to avoid an economic downturn. By doing that, in order to do that, we're going to, continue to maybe cut interest rates. That's one way to do it, right? Keep interest rates low. That's going to cause inflation. We're going to, flood the market with more money by issuing more government debt, right? That's going to increase our debt and also increase inflation. The concern is, if something outside of control happens, are we so propped up at that point as an economy that the fall is going to be harder and faster? I don't know, but it is what I worry about. Not an economist, hashtag not an economist. Okay. So don't come at me. But this is the way that I think about it as an accountant. This is where my brain goes. And as someone who's interested in, how all of these things impact one another and how these choices matter. The choices that our government is making matter, and they're weighing different things. And what I hope, right, what we don't want to happen, and I say this even when we're talking about things like tax deductions and when you write off things and all of this, I talk about this all the time. We don't want to sacrifice tomorrow for today, right? We don't want to, at least, at a certain point, right? We need to make a decision that's best for us over the long term, not just what's going to be best for us in the short term. And that is what I hope for whatever party is in power, that they are not just thinking about what's going to get us through the next 4 years. They're thinking about what's going to be best for us as a country moving forward 10, 20, 50, 100 years, 200 years. I want to be around, right? I want my kids to still be living in a country that has all the things that we have today, right? And so these are the things that I think about. They don't keep me up at night because I can't control them. So there's no reason for them to. But it is kind of these rabbit holes that I will go down. And now you've had a little bit of a glimpse into what one of my rabbit holes looks like. So have some fun with some charts. You go do some rabbit holing yourself. Like I said, some of these sites are just really great for poking around, playing around, getting the data, and then trying to understand how it all fits together and how it's all related, because it is, right? We don't do things in a vacuum. They have other impacts, and there's no one solution where it's all the positive impacts, right? There's always going to be knock-on effects. It's just, it may affect certain groups more than others. And that is what we're seeing now, right? The choices that are being made are favoring those that have the assets. They just are, right? Okay. All right. So there you go. There we have it. I also wanted to give a quick update on tariffs, tariff refunds. That's something, if you haven't been following it, Trump's tariffs were essentially struck down as unconstitutional. They're trying to figure out how they're going to refund all the money that was collected through tariffs. It's very difficult right now, and there is not a very clear process on how to do this. You do have to be the importer on record in order to be eligible. However, that's one of the things the NFIB is actually out there actively talking about and discussing is, what about the knock-on effect to the small business? Maybe you weren't the importer, but you still paid higher prices because you were buying from someone who was an importer, right? Shouldn't you be able to get something back? What about if you're a consumer and you paid higher prices? Like, who, at the end of the day, this opens up that discussion about who ultimately is the one who paid this. By the way, it wasn't countries abroad. Could it have affected, their exports? Sure. Maybe, right? The demand for their exports may have changed some, but they didn't pay those. The American people did. The small businesses, the big businesses, and the consumers paid this. And so now the question is, how do you get it back to the people that it actually affected? We can't go back and say, okay, and that also, by the way, talking about inflation, is part of the reason we saw inflation uptick last year. It was related to some of these tariff things. So again, more tax revenue to the US had they stayed, but higher prices for people. There are effects to everything we do. Not all is good, not all is bad. But more to come on that. There is a good webinar as well that the NFIB did specifically for small business owners who are affected by the tariff things going on. So if you're interested, I'm going to put the link for that webinar down below as well, so that you can go check that out yourself and kind of watch what the thought process is. I think it's going to be a little bit of a wait and see to see how I wouldn't count on any of this money. If you get it, let me know. But certainly let it be like, some extra money, but don't count on it to run your business, because even if you do get it, it's probably going to be a hot minute. Those of you who went through the employee retention tax credit, whole thing, you probably realize that this stuff isn't quick. I love that the employee retention tax credit was supposed to be, again, something to help people in the moment related to COVID. And there are people who still have not received it today. It's 2026. This is crazy. So don't hold your breath is what I'm saying, but that doesn't mean give up on it. We'll keep giving you updates as there are any that might be relevant. Okay. So that's the news section. Sorry, it was a little long today. I'll go shorter on my other sections, maybe. But there's a lot I wanted to cover. All right. Now I just need to hit the right button the first time. Sorry, guys. All right, moving on. Let's talk about to-dos. What should you be doing right now today? Well, the first thing I'm going to tell you to do, just off the back of what we just talked about, is look at your prices. I know I say this a lot. This is an economy, an inflationary economy. You need to be reassessing prices. I used to say once a year. I don't believe that anymore. I think every single quarter, at least, you need to be looking at the costs, and that includes labor costs, right, to produce the product or service that you are selling. And you need to make sure that you are adjusting your prices accordingly. I actually did a video that just came out today, like 38 minutes ago. Okay. That is all about how to calculate your prices. It shows you, walks you through my actual calculation to determine the minimum price you should be charging. Okay. And we talk about how to balance, your pricing versus the value you provide versus your cost, all of those things. So make sure to check out that YouTube video. Hopefully it'll be really helpful. I just want people reassessing this. I do not want small business owners to end up being the bag holders who at the end of the day are the ones that get squeezed. And what happens when we get squeezed is we get squeezed out of business. And then people, that is how the economy can collapse, right? You squeeze the small business owners so much that what about our employees? Well, they lose their jobs. Now we're dealing with, people who don't have as much money to spend, and therefore consumer spending falls, right? We're also dealing with less from an income tax collection. So the government has less revenue to do the things that it needs to do. Our debt to GDP gets higher, and it's bad. Small businesses need to stay healthy to have a healthy economy. They absolutely have to. That is why I do this work. That is why I want you guys to know about this, because it does affect you, both as a small business owner, right? And as an end consumer, as a constituent of this country. Okay. So that's number one. That's the first thing I want you to do. The next thing I want you to do, again, along these lines, right? When we think about how can we protect ourselves in situations like this? How can we make this work for us, right? I've said it's asset holders. Asset holders are the ones that are going to be doing better, especially when you have assets that are rising at a higher rate than inflation. That's going to be really important, or at the very least, at the rate of inflation. Do not put your money, park it in underneath your mattress. I understand the desire for that, because I also think there's concerns then about the banks, and there's a whole, discussion to be had there about whether the banks are safe and what happens under like a total collapse. And, but ultimately, I still believe that the key is going to be making sure that you are able to get a return on your money. Let your money work for you, even if you're parking it in a money market account, which is, again, one of the safest things that you can do with your money and still earn interest, or a high yield savings or something like that. Make sure you're earning interest, because otherwise you are actually losing money every single day. Every dollar of cash that you have sitting in a bank account not earning interest is actually you losing money and losing value every day. And it will continue to be. Remember, deflation doesn't happen. It's going to continue to happen. So make sure that you are part of what's rising up, right? Make sure you're rising with it, rising with the tide. Okay. All right. Let's see. And the last thing I was going to say to do as well is taxes. We just had April 15th was taxes. I'm even more impressed for those of you that are watching this now, because a lot of people I find either file their taxes or file their extension and then just don't even want to talk about it or think about it for several months. And I understand that. So if you're here, kudos to you for being here and wanting to talk about money and finances, even after tax time. If you have not, even if you filed an extension, if you expect to owe money on taxes and you have not paid in an estimate of that money, I need you to do that. Why? Because even when you file an extension, it is an extension to file. It is not an extension to pay. This is something a lot of people get tripped up in. They think, well, I don't need to pay in what I owe. How do I even know what I owe? I filed an extension. I'm not going to, know that until later. The government expects that you will do some kind of a calculation to determine how much you are going to owe, or at least pay in the equivalent of what you owed last year. So just make sure you're under a safe harbor if you haven't fully paid in the money you expect to owe this year, because otherwise you will get interest and penalties for not paying in. And the quicker, right? Don't think like, well, I passed the deadline anyway, it doesn't matter, I'll just wait till October. No, it accrues every single month. So the quicker that you are able to pay what you think you're going to owe, the better. All right, cool. Okay, that is it for to-dos. And now I'm going to take a couple of questions real quick. I love these new graphics, y'all. They make me happy. More to come. You're going to see a lot more to come of all the fun things. We've been working real hard behind the scenes, and we are ready to get it out to the world. I know my team is ready. So you guys are one of the first to get to see our new vibe. Okay, so questions that we have. I'm going to share a few. Some of these came from my Facebook group, actually. There is a way to be submitting your questions, so we'll put that in the chat. You can submit your questions for Power in Numbers Live. I pull questions from various different places, but the people who submit through the official means get the first dibs on having their question answered live. Okay. Okay, so here's the first question I'm going to put up. I'd like to protect people's identity just because I haven't asked them if they're cool with me putting this on the wider internet. Okay, so somebody was asking, what are you currently paying for bookkeeping right now? Curious what the going rate is. She specifically has a six-figure coaching industry. Okay. I typically say, y'all know what I'm going to say. You know I'm going to say it depends, because it does depend. And I'll say this, how much you pay in bookkeeping rarely is going to be specifically tied to how much revenue you make. There's probably a correlation there, but it's not, typically that's not how they're going to price it out, right? It's going to be based on, number one, what is your bookkeeper actually doing? What are the services that are provided in that? Not all bookkeeping is the same. I think we think of it as like a check the box. You know, if you're just having them categorize transactions and run a P&L, okay, that's one thing. If you're having them, work on AR or AP, pay bills, all that, that's going to be a different cost, right? If you're having them do any kind of proactive analysis or advice for you, that's going to be another cost, and it's going to be a lot higher for those who are qualified in this, right? Because that's more kind of CFO advisory level work, and that comes at a higher cost than compliance work, which is just kind of, ticking the boxes. So that's what I would say about this, right? Is know what you're getting, what are you paying for? And, if you're on the lower end, right, it may be, again, I would find it hard. I can't imagine finding a qualified bookkeeper to do things for less than, say, $300 a month these days. We just looked at a bunch of inflation charts that might seem high to you. There is a bit of an element of you get what you pay for as well for some of these big box, type of bookkeeping firms, where, we saw that with, one of the big ones that went belly up, went belly up a couple, I guess that was a little over a year ago. And that was a big problem, but they were one of the lowest in the marketplace. And I still think that they, started at like 200. So again, you're going to get a little bit what you pay for, but the key is to make sure you know exactly what you are getting. Also, the more transactions, the more bank accounts they have to reconcile, right? If you have 5 different bank accounts and, 3 credit cards and all this that they're going to reconcile and lots of transactions, that's going to cost higher than, 1 bank account and 1 credit card, right? So just be aware of what you're asking and ask around. I typically recommend not to pay more than, say, 2 to 4% or so of your total revenue in accounting and bookkeeping, just because if it's going to end up being that, right? If you're not at the revenue level where you can find somebody for that cost, it's probably still applicable to do it yourself. There are some great softwares. Actually, I didn't put this on my sheet, but I would like to link to our accounting software quiz. So if you go to jamietroll.com/accounting quiz, then there is a quiz for what software is best for you. And if you are in that situation where you are going to be paying 10, 20% of your revenue to get bookkeeping done, I want you to do it yourself. for the time being, until you get to the point where you're making enough revenue for that to make sense. So here's what that is going to be. Thank you for my team for being on it. JamieTrull.com/accounting quiz. We have a quiz that helps you determine what, and there's a lot of you can automate it a lot of ways. I have tons of YouTube content on QuickBooks, Xero, all these different features, or even a spreadsheet if that's what's best for you, right? It's not hard if you have a more simple business, and that can make sense for a while. Okay, cool. Oh no, we'll have to check that, Stacy. I was wondering why I wasn't getting very many comments. Well, our team will check that for next time, make sure that we have the ability for you to comment on YouTube. But thanks for letting us know. I was like, where are all my YouTube people? We usually have several, but not today. Okay. The next question I had was a very similar question. So I thought I would talk about this directly after that one. And that is about how much you should be paying for payroll. So this question was actually in a different group, but I found it a really interesting question and I wanted to talk about it. So someone said, who do you use for payroll? I got a quote from a company for $13.50 a month, which seems outrageous, but maybe I just don't know the drill. You can tell this was a very popular one because we had there's a lot of people with the wow face, lots of comments on this. What I want to say to this is, again, it depends on what you're getting. When we say payroll, what does that mean? And also, how many employees do you have, right? Some of that's going to factor in. But what do you mean when you talk about payroll? And there's, payroll in terms of just running and filing your regular payroll reports, right? And calculating out your withheld taxes and running the paychecks. That's what I think of as payroll, but there's also a full HR suite you could get. So that could be onboarding. That could be, a whole lot of things around more the HR side of things that they might be handling almost as an outsourced HR. At $13.50, I would expect that to be an outsourced HR as well. And there to be a lot of capabilities, not just running payroll. And I would expect that you have a lot of employees. So that would be my guess. But this is one of those areas where I think there's a huge room for savings. There are so many platforms. It used to be you had to go to an accountant. Let me tell you, an accountant, if you go hire an accountant to run payroll, they're just logging into a Gusto or an OnPay or an ADP and running it and taking probably 5 minutes to do it and then charging you extra, right? Charging you for both the subscription fee and also for their work and time. It's not hard, right? Payroll is actually pretty easy to manage in-house. And a lot of payroll systems have auto pay, especially if your people are salaried, right? It's pretty easy to just kind of I have mine fully on, auto pay, where only if I am needing to do like an extra payroll run, which again takes me like 2 or 3 minutes to set up. But other than that, everything is automated. It's a little more work, obviously, if you have hourly employees and you're having to enter in that information. But again, it's probably worth doing yourself or having someone on your team do, rather than paying a company to do that, because you're going to get upcharged for it. And I just think there are so many tools available these days, including like our friends OnPay, right? Like if you're looking for a payroll company, I pay like $60 a month. I have 5 employees that are full-time. I pay $60 a month and I barely have to look at it. And I have a 401k through there. They file all my reports. I can even pay contractors through there. It's, so easy to do. So when the question is $60 versus $13.50, right? Like if you're getting the same thing, definitely need to go with the $60, unless what this quote has a lot more stuff. So just understand what exactly they're doing and then compare it with other options, but always make sure you're comparing apples to apples. A lot of times if you see huge differentials in the marketplace, it's not because one is just more expensive than the other. Sometimes it is, but it's often because what they're actually doing is not comparable. They're doing 2 different things. So figure out what you need and what meets your needs. If that meets your needs and seems like something you have the cash flow to pay for it, okay. But just make sure you're checking all of those things first. Okay, and then I had one extra question. And this is just a question that I've been getting a lot. And a lot of people after tax time would come in and say, how do I make my taxes lower next year, right? Some people ask me, how do I make my taxes lower this year? Oftentimes by the time you get to this year, right? By the time you're filing taxes, there's not a lot you can do, but right now you can be thinking about next year. So I actually did a video recently that just came out about how I cut my taxes for 2025. I just filed them, about a month ago. Cut my taxes in half from what they would have been. And I tell you exactly what I did. I normally don't go too deep into my own stuff typically because that feels really vulnerable. I don't tell you amounts because that would be weird, but I do tell you exactly what I did to cut my tax bill. And I'm confident in it because I'm putting it on YouTube for everyone, including the IRS, to see. So that's how confident I feel in these strategies that I utilize. I know that they are on the up and up. I'm a CPA. I'm very risk averse. So there are things you can do. Obviously, the more income you make, the more opportunity there is for that. But even small businesses like you and I have some opportunities that we can use to make sure we're not paying more taxes than we need to. So if you're interested in that, definitely go check out that video of mine over on my YouTube channel. Okay. All right. I think that's it for today. Y'all have been great. Comment down below if you have questions, thoughts, anything like that. Again, we'll make sure in the comments you should see all of the various links and everything that you need. Also, OnPay, $100 if you use my link. So go check that out. Oh, you know what? I'm going to try this because this was another fun thing that I did. I forgot to put it up, but I'm going to do it now. Check this out, y'all. We got a QR code. How fancy are we? We're so fancy these days. I'm going to have a producer here pretty soon. Not really. That's how I save money. I am my producer. But you can scan this if you want to find out more about OnPay, and you also get $100 by using that link. All right, y'all. Y'all are the best. I'll see you next time. I will be back here. Actually, we're going to be changing next month, so stay tuned because I'm going to be out of town. So I think we're going to be doing it a week early in May. So stay tuned for when we're going to be live for our May Power in Numbers. All right. Bye, everyone. See you later.